Welcome to Believing the Real, a series of talks on the theology of the real. In this episode, chapter 18 of our discussion of the theology of the real, we will continue reading Nicholas Kraft's and Peter Fearon's book on the Great Depression of the 1930s, Lessons for Today, and examine the depth of the catastrophe and the helplessness of a system that did not understand money and clung to the idea that it was something tangible. Hello, welcome to episode 18 of our discussion of Believing the Real, a theology of the real, in which we see how the world evolves in a direction which both frees up the abilities, the potentialities of human life, and in which, in fact, it is the inter-subjective world that we live in which creates our ability to live in the real, as it were. But because of faioti, which is the fundamental ignorance of the individual, where every individual, in fact, cannot really assess the reality in which he or she finds himself or herself, we rely on ogsek, on the idea that only a group sharing experience can know, and therefore we live within the realm of atiswurium, the inter-subjective world of others represented in our minds. And money, since it is embodied trust, allows us to have a view of this tiswurium that we live in and the way in which our various ability to trust in the value of something that is only agreed on intersubjectively actually makes or breaks the world, our world. And we have been reading a treatise by Pearson and actually Kraft and Fearon on the Great Depression of the 1930s. And today we will look at the actual breaking of the world. How did the world break in 1928, and how did the Great Depression actually begin? So Kraft and Fearon write that in January 1928, the Federal Reserve decided that action was needed to curb volatile stock market speculation, which, if uncontrolled, could end in a stabilizing collapse. They saw the writing on the wall. They saw that there was a collapse coming, but how did they handle this? The Fed changed course and added several years of easy credit. So they gave easy credit. It was easy to get money. The economy expanded. Everything was blooming. Everything was roses. So instead, they introduced a tight money policy. No more money, which began with the sale of government securities and a gradual increase in discount rate, which rose in steps from 3.5% to 5%. The Fed was fully aware that a sudden rise in interest rates could be destabilizing for business and might bring a period of economic prosperity to an unhappy conclusion. To avoid this possibility, the monetary authorities aimed to gently deflate the warring bubble on Wall Street by making bank borrowing for speculation progressively more expensive. Monetary policymakers believed that by acting steadily rather than suddenly, speculation could be controlled without damaging legitimate business credit demands. Because as we saw, it's always two levels in money. There's the money actually working within the life of people, working in the economy, and there's the surplus money that is used both for storage and for speculation. It's no money that you need now, so you're going to risk it in order to get more money. So that when everything is cheap, the money is cheap, then not only business blooms, but also speculators bloom. this shadow of the actual potential of money, i.e. Speculation on it, also expands. But speculation itself can be a boon, sorry, because say a speculator makes a lot of money and goes out of the market and uses that money to found a business or to invest in other things, then that money is put into the economy. In fact, you can never actually, no one has ever been able to really distinguish, except in rhetoric, between money in speculation and money in production, although it's obviously clear that these are two distinct uses of money. Are you borrowing money from the bank in order to establish a factory, or are you going to speculate on it? But often, when you speculate on it, the speculator makes a killing in the stock exchange and can have a change of heart and put the money back into the economy, but often not, just speculates more. So that is the bubble. So now they want to break the bubble, but they want to do it easily, gently. So how do they do that? So to avoid this possibility, the monetary authorities aim to gently deflate the worrying bubble on Wall Street by making bank borrowing for speculation progressively more expensive. Monetary policymakers believe that by acting steadily rather than suddenly, speculation could be controlled without damaging legitimate business credit demands. It seemed a good idea at the time, but unfortunately, this policy had serious, unforeseen domestic and international repercussions. Because this policy did not think about what the implications would be for the more general system. It was more like, it's a good idea, but it was tunnel vision. The new higher rates made more funds from non-bank sources available to the ever-rising stock market, and speculation actually increased. Because if you couldn't get it from the bank and you wanted it to speculate, then you were willing to pay good money to other lenders, not just banks. And since everyone believed in the system, that everything was flourishing, people were ready to give money even when the banks were no longer a good option. Many corporations use their large balances to fund brokers' loans, and investors who normally looked overseas found loans for Wall Street a more attractive option. Money was plentiful, corporations had it, so if you couldn't get it at the bank, they were willing to give it to you. So more money flooded the market. Unfortunately, countries that had become dependent on U.S. capital imports, for example, Germany got a lot of money from the U.S., suddenly no more, because people got it internally. They didn't need to go to Germany for it. So they were deprived of essential support for their fragile economies. Moreover, the Fed's tight money policy led to an influx of gold, which coincided with a drive by France to dramatically increase its bullion holdings. The accumulation of gold by the US and France put added pressure on other countries as they saw their meager gold reserves further depleted. So because the money economy had not developed to the point that countries were using fiat money or fiat money dictated by the sovereign, which has no backing in any other currency except the sovereign money itself, you cannot get anything for a franc but another franc, anything for a dollar but another dollar bill. That's it. There's nothing behind. All the gold has been ripped off, and we will see that this is in the future. This is in the late 60s when Nixon came to the fore with his needed to fund the war of Vietnam. But already the countries were not on the gold standard, but still the gold reserves were there in the background. They were there as the basis of the economy, as it were. And now the gold was put in the US and in France. And in fact, we will see it was sterilized. It was taken out of the market because the countries wanted it as a sort of backup because they still believed it had real value, which is another fallacy of the way that governments think about money as something tangible rather than something that is based on trust. So this was the beginning of the break. It was a move by a government to actually halt the market before it broke. But they took the wrong steps. And what happened was they actually broke the market. This was the trigger that would lead to the breaking of the market. So let us continue with this review of the great tragedy of the crash, the anatomy of how things actually collapsed. From the peak of the 1920s expansion in August 1929 to the trough in March 1933, output fell by 52%, wholesale prices by 38%, and real income by 35%. Company profits, which had been 10% of GNP, the gross national product in 1929, were negative in 1931, and also during the following year. The collapse in demand centered on consumption and investment, which experienced unprecedented falls. Gross private domestic investment, measured in constant prices, had reached $16.2 billion in 1929. The 1933 total was only $0.3 billion. In 1926, write Crafts and Fearon on page 10. In 1926, gross expenditure on new private residential construction was 4,920 million. In 1933, the figure had fallen to a paltry 290 million. Consumer expenditure at constant prices fell from 79 billion in 1929 to 64.6 billion in 1933. Durables were especially affected. In 1929, 4.5 million passenger vehicles rolled off assembly lines. In 1932, 1.1 million cars were produced by a workforce that had been halved. So you see the whole standard of living is taking a plunge. People are just going down. It's the whole economy, the whole civilization is being constrained. Automobile manufacturing and construction had been at the heart of the 1920s economic expansion. But as they fell, supporting industry tumbled too. It's like a domino effect. Because once cars are going down, all the suppliers in the chain, in the network of people involved, also suffer, and workers laid off. In particular, companies producing machinery, steel, glass, furniture, cement, and bricks faced a collapse in demand. The number of wage earners in manufacturing fell by 40%, but many, lucky enough to hang on to their jobs, worked fewer hours and experienced pay cuts. The producers of non-durable goods, such as cigarettes, textiles, shoes, and clothing, faced more modern declines in output and employment. Of course, because people still needed to dress and smoke, although it would have been good if they stopped smoking, but this is a terrible addiction. To be discussed in some future talk. But anyway, once it begins to contract, it's like a snowball effect. Things become worse and worse because it's like the whole market is contracting, because one industry contracts, then another, and less people have less money, people have less money to buy things, so more factories close down, so everything contracts. The most dramatic price fails were in agriculture, and a fall of 65% in farm income was unsustainable for farm operators, especially if they were in debt. So this is interesting, because you would think if money is is a commodity, is linked to commodities. Like they have all these, the real prices and so on, and they look at the real value of things. And this is linked to the consumer price index and so on. And you think that commodities, like the very life of people, what people eat, would be at the core, and that would be stable, but it is not. In fact, this is the most dramatic fall. As Crafts and Fearon write, unlike manufacturers, individual firms did not reduce output in response to low prices. Indeed, the reaction to economic distress was to produce more in a desperate attempt to raise income. Because when people don't have money, the prices go down. They can't buy as much. So they can't buy as much. They don't buy, the prices go down. There's no demand. So where before you had a lot of money, so you could say you would buy, say, a kilo of tomatoes and 2 cabbages. Now you think twice and you say, okay, let's just buy 1. And you look for the cheaper price. You don't have the money. So prices go down. So what would the agricultural sector do? The reaction to economic distress was to produce more in a desperate attempt to raise total income. The result was the accumulation of stocks, which further depressed prices because they had all this food that they couldn't sell because people weren't buying because they had no money. So they created more, but there was no market for it. Nor could farmers lay off workers, as most only employed family members. As banks and other financial institutions foreclosed on farm mortgages, distress auctions caused so much local anger that the governors of some states were obliged to suspend them. Farmers who were unable to pay their debts put pressure on the undercapitalized unit banks that served rural communities. As bank failures spread unease among depositors, the natural reaction of institutions was to engage in defensive banking. Loans were called in, and lending, even for deserving cases, was curtailed. The banks gained liquidity by bankrupting many of their customers. Rural families were forced to reduce their purchase and manufactured goods, adding to urban unemployment. The bitter irony of starving industrial workers unable to buy food that farmers found too unprofitable to sell helped to undermine faith in the free market economic system and prepared the way for regulation and government intervention. So you see what happens when breach of trust in money occurs. Once the breach of trust occurs, we see that people, rather than understand that they need this trust to make the market flourish, turned to grabbing their gold, hoarding what they do have, as if this could solve the problem, as if the assets that one holds have any value that is inherent in them rather than as part of the tizwurium. And this causes retraction from the market and a terrible situation where in a sort of every man for himself world, everybody looking out for their own agendas without looking at the bigger picture of spreading the trust, everything breaks. The banks want liquidity. What is liquidity? They want to hold on to some idea they have about the tangibility of money. So they feel that if they don't give money out, then they are holding on to its value, which they are not, because it will continue to devalue because it is not used. It's just there. And so none of the great forces of human cooperation through trust can work on it. And the farmers, even though they have the produce, there is no money there to take it from them. There is nothing to mediate between themselves and the workers. And the workers who have been laid off do not have the money to buy the produce that the farmers are just want to sell, but they can't. So everything breaks apart. And so instead of realizing that trust is at stake here and reinvigorating the money with liquidity, which is what happened in the Great Recession, and stop the breaking of the bank, because if there is liquidity, if the banks feel they can continue to give deposits and loans and money, and people have enough money to buy the produce, everything flows smoothly. And again, the market can expand and people can cooperate with each other. But when people sink into distrust and try to latch on to tangibles as if money was something tangible, clinging to this idea of money as something material, then the whole system breaks. And we shall see more and more of this as we continue reading in Crafts and Fearon. As we continue reading, we will see how indeed this misplaced conception, how this misconception of money as something tangible rather than embodied trust between human beings continued to undermine all the efforts that were made to stop the fall. As Crafts and Fearon write, the slide from mid-1929 to spring 1933 was not smooth and continuous. Periodically, it seemed that the Depression had bottomed out, and Hoover was able to declare that recovery was underway. A destabilizing fall in consumption occurred during 1930 as households heavily burdened with installment debt reduced consumption expenditure in order to avoid default. So they wanted to be good citizens, and they did not want to renege on their debts. And we will have a separate discussion of the whole idea of debt and of meeting one's obligations and the way that this is embedded in the very pre-wiring of human societies, and how this hierarchical conception of creditor and debtor, the relationship between them and the obligation to meet one's debts, influenced both governments and individuals to act in ways that often undermine both the market and individual welfare. So people were starving, but they were paying their debts. They did not want to default, so they put back on consumption. But by putting back on consumption, they ultimately withdrew money from the system and ultimately harmed it in various ways. So in spite of consumer uncertainty, it seemed possible that the economy would revive. This expectation was quashed by a wave of bank failures at the end of the year. Although mostly confined to small banks in the southeast of the US, the failures gave depositors a warning sign. Indeed, bank failure was a major contributor to the worsening depression, and there were two major crises, the first in autumn of 1931 and the second during the winter of 1932-33. Unlike the UK, where branch banking was the norm, the US banking structure was dominated by thousands of small standalone bank units. The vast majority of these unit banks could not satisfy the minimum capital requirements for membership of the Fed, but they were an important part of the culture of rural America, because since everything is based on trust, your own good banker could help you organize your financial life, so long as the whole community is in concert in that trust. However, in 1929, nearly half of the states in the Union expressed their distrust for the concentration of financial power by banning branch banking. So, in fact, the first move was to actually ban the big banks, those supported by the feds, and actually support those more trusted local institutions. Small towns, villages, and even hamlets wanted and actually supported their own independent banks. Many of these undercapitalized units struggle to survive even in good times. In fact, during the 1920s, approximately 5,000 banks disappeared through mergers or failure. When there's a big difference between merger and failure, but okay. When times were tough, unit banks were the first to fail. Indeed, the monetary authorities who believed that the country was overbanked welcomed a reduction in the number of undercapitalized banks. The combination of a banking system with many weak units and incompetent bankers, a culture that accepted bank failures, and a depression of unprecedented severity explained much bank mortality. However, U.S. bank problems were not confined to small units. Larger banks, who were members of the Fed, also succumbed with devastating implications for economic recovery. So, these smaller banks, if we could imagine a world where they were supported by the great liquidity of the G20, which supported all the banks in the world after the recession of 2008, had these smaller banks had such backing, would they have failed, or would they have been able to provide greater trust in that people knew each other, believed in their banks, supported their banks? There was a deep human element in these banks operating, and the trust was very deep, so that even though they were liable to fail, and it was a culture of bank failures, still the local communities supported their banks because they did not consider them as a risk, because they were close to them. They felt that they could trust them. And only when they really became, when the whole system crashed and the banks crashed, then there was nothing there to provide the trust that was needed to restore the economy. So let's see more of this on page 11. During the first half of 1931, the economy revived, but hopes were dashed in the aftermath of Britain's abandonment of the gold standard in September, when a wave of bank failures served to undermine the diminishing faith of depositors who rushed to withdraw their money, thus making closure of the banks inevitable. Because once trust is lost, the bank has no function. It just closes. Once you stop believing the bank cannot survive, because bank is embodied faith. It is a bank of faith. Once faith breaks, it breaks the bank. It's so simple, but so invisible, because people continue to cling to the value of tangibles. For example, the gold standard. So once Britain left the gold standard, it breaks the trust, because we want the gold. We want the tangibility. Now, what happened to those funds that were withdrawn? So Crafts and Fearon write that many kept their withdrawn funds idle rather than trust another bank with their savings. In other words, depositors withdrew their money from the banking system and made it impossible for many banks to conduct a business. So you see the vicious cycle that is set up when people trust or believe in the tangibility of money and thereby distrust its actual function of mediating between people. So if they had taken out that money and put it back in the market, then the market could have flourished, but they sat on it. When you sit on money, whatever money it is, it could be dollars or gold or diamonds or whatever, you just sit on it, it's just an object. It does nothing. It no longer works in this great thesaurus that we live in. As a result, Crafts and Fearon, credit markets were in disarray, and even the requests for loans by sound businesses could not be met. Everything breaks. economic expansion in the summer and autumn of 1932 was reversed during the policy vacuum between Roosevelt's electoral victory in November 1932 and his inauguration in March 1933. The uncertainties present during this lame duck period led to a further wave of bank failures, which became so serious that by the time Roosevelt delivered his inaugural address in March 1933, the governors of 35 states had declared their banks closed to prevent almost certain failure, and strict limitations on the withdrawal of deposits had been introduced by the others. There was a sharp difference between the British experience, where no financial institution failed, and the US, where financial paralysis was the end result. Indeed, this difference between the British and others is something very interesting when we think of the way the British uphold their sovereign, their crown, the mutual national trust that the British seem to have, which was broken for the first time in 2008 with the run on Northern Rock, was it? So this is also very interesting. In any case, in the US, the banks broke. And this, of course, led to deeper and deeper depression. And now, Crafts and Fearon ask on page 12, why was the Fed unable or unwilling to ensure banking stability? A central bank would normally offer help at times of crisis by rapidly adopting a low discount rate and by pumping liquidity into the system via engaging in open market operations, which is what happened in 2008. In their classic work, Friedman and Schwartz emphasize the contraction by 1/3 of the U.S. money stock between 1929 and 1933, a reduction which they believe fully explains the severity of the Depression. Moreover, not only was there less money in the system, but as Crafts and Fearon write, when faced with a policy choice, the Fed always opted to follow the gold standard rule because gold was the tangible thing. As a result, during late 1931, following Britain's exit from the gold standard, the dollar came under speculative pressure, and the Fed reacted to gold losses by raising interest rates and pursuing a tight monetary policy. This was the correct policy if protecting the exchange rate was the priority, but it was exactly the reverse of what was required to support a beleaguered banking system. This is so terrible. This action also drained gold from other countries and put enormous pressure on their central banks. During the winter of 1932-33, the Fed again raised interest rates to protect the dollar from external speculation in order to halt gold losses. Little wonder that so many banks, in a system that had been under sustained pressure for over 3 years, closed their doors. There is no doubt that monetary policy had serious adverse effects during the worst Depression years. So, this clinging to the gold, this saying, no, we won't let the gold go out. Let's put the interest up so that it would be more expensive to people to buy gold, and therefore the gold will be retained in our coffers. This made the gold lie dormant and in fact undermined the market, so that indeed there was less money in the market, and even the money there was, even if it was a gold standard, it was underutilized because gold was no longer operational in the market. It was just lying there as some fixed idea in the minds of the people making the fiscal decisions. So also, unemployment was one of the great curses of the Depression. Unemployment is really something that is at the very core of what the damaged trust can lead to. Because what is employment? It's people working together within the monetary system to create products, surpluses, services, etc., all through the exchange of the embodied trust of money. Now, when the money system breaks, when there is not enough money, and what we saw here happening in the Great Depression, employment also breaks, because because for every employed person there is an employer, and that employer has to be able to pay the employee. So if all the prices are going down and the market is breaking, there is no money coming in to pay the employee, and the employee is laid off. So as the market contrasts, people are thrust out of productive lives and can no longer be productive within the market, even though they are ready and willing and able. The market cannot contain them. Much in the same way as we saw with agricultural produce. There was a lot of produce there, but nobody could buy it. It's there. The capacity is there. The market is there. The ability is there, but there's nothing to support it because the money is broken. So as Kraft and Fearon write, widely accepted estimates show that the percentage of the U.S. civilian labor force without work rose from 2.9% in 1929 to a distressing peak of 22.9% in 1932. So like a fifth, more than a fifth, almost a quarter of the people were sitting idle, not becoming involved in the economy. And this was, as we will see in a moment, not just them. Even those who were still working were also having great problems. In any case, unemployment was rampant, and many classified as employed were also on short time, and some also had experienced wage cuts. So even if you were employed, you weren't employed to the full extent of your abilities, or you'd be working part-time, or you would be working full-time on lower wages, and you were happy to be employed. You were happy to take the cut so long as money was coming in because you were so desperate. Unlike Britain, the US had no national system of unemployment benefits. The jobless were subjected to a harsh regime which included dependence on miserly, poorly administered local relief. Those most affected, including the young, the old, and ethnic minorities whose unemployment rates were relatively high. In addition, social workers stressed that those who had been out of work for long periods became increasingly unattractive to employers. Loss of income and employment uncertainty combined to reduce consumer spending. So the market contracted further, and so production also contracted. So more unemployment. It's like a vicious circle that it continues to contract and contract and contract because there is that medium of easy trust where people accept money, have money, and the whole economy evolves, has been placed against a wall, has come up against a terrible wall, and everything is contracting. Even fortunates who felt secure in their jobs and whose real incomes had risen were deterred from consumption by the persistent deflation. So even those who had money, they wouldn't spend it. Why buy a motor vehicle or a house now when both would be significantly cheaper in a few months' time? Because everything is dropping, everything is contracting. So even if you had a little stored, you had some money or you had employment, you would still be very frugal about spending that money because you were waiting for an even more lucrative opportunity for those with money. And we will see how those with money often abide the downturn so that they can get bargains at the bottom. We see this often in the housing market, where after the great bursting of the housing bubble following the subprime crisis, there were certain companies that had been just waiting for this opportunity to seize incredible bargains at basement prices. So that's another thing. In any case, people were waiting, abiding their time. They weren't rushing to buy. Deflation increased the burden of existing debt and acted as a warning against the accumulation of new obligations. Deflation also intensified business uncertainty and further undermined the confidence necessary to make investment decisions. Traditionally, price falls were seen as one of the natural self-correcting mechanisms of the market economy. Deflation automatically led to a rise in real incomes, even with wage cuts, it was argued, and consumers would soon start a purchasing drive that would lift the economy out of recession. The persistent price falls over such a long period, however, brought about a paralysis in both consumption and investment. Potential spenders wanted to wait until the price falls had reached their nadir before they committed themselves to major purchases and new debt. So what lies behind this description of Crafts and Fearon on page 13 is, of course, the loss of trust. Because if the trust in the economy is maintained, so it makes sense to buy things when they go down, because the market is always in flux. So you can buy it now when it's cheap, and you trust the market that ultimately you're able to sell it at a better price, or even at the same price, but not lower. But when the market is deflating and there's no trust in the market itself, then people do not want to go into further debt because they will be even more encumbered. They do not want to spend the money they have because they feel that it would be, this is a time where prices are going down even more. So from both ends, both those who have money sit on it, and those who don't have money are shy of getting it. So both the equity and the debt aspect of the markets are in stagnation, in paralysis, through this loss of trust. And of course, as I keep repeating, even the equity part of the market is also based on trust, even though debt is more salient in the way that it displays this trust and non-trust. Because when you take a debt, is one person trusting the other that his or her life stream will produce the surplus necessary for returning the debt. It's like mortgaging future trust, while tangible assets that you have, like real estate or gold or whatever, they give the illusion that you have embodied trust, that you hold it in your hand. But in such times of deep deflation, both equity and debt, both types of trust are put on hold, and people just tend to sit on what they have, on the money they have, and wait it out. Now, the important thing here to see is that despite this recession, despite this slump, despite this terrible shock that civilization sustained, the ultimate trust in the value of things did not go away. Gold, even though it was not used and the markets collapsed all around it, continued to hold the trust of people. So something did not break here. Even though everything was broken, because trust could no longer flow, people did believe that if you had gold, for example, it would still buy things. And when recession was over, all this gold came out. Or let's say when people began trusting the system again and trusting each other again, those who had gold could add it to the money that was flowing in the market, and they were the rich ones. They were the people who had surplus when the market began emerging again. While when the market was in recession, they too contracted and no longer participated in the ebb and flow of the market. So why wasn't the government putting a stop to it, flooding the money, the economy with money, just as it did in 2008? We can see this, some of the explanations for this, on page 14 of Nicholas Kraft's and Peter Fearon's book on the Great Depression of the 1930s. In the early 1932, following Hoover's lead, Congress approved the Reconstruction Finance Corporation, RFC, with a remit to lend to distressed banks, which was the responsibility of the Fed, but one it failed to discharge because the Fed was so conservative in its adherence to tangibilities, it failed to support the banks. So now an act of Congress was going to tell it to provide liquidity, to allow liquidity to provide the banks. The hope that the RFC, acting as a lender of last resort, would bring stability to the financial system. And indeed, if it had gone through properly, then perhaps the Great Depression would have been cut short, as the Great Recession was stopped immediately. But the hope that the RFC, acting as lender of last resort, would bring stability to the financial system was compromised by a politically mischievous congressional decision. This is like the critique between the lines. Well, now, in retrospect, it was mischievous. Politically mischievous congressional decision to publicize the names of all institutions that approached the RFC for financial help. Hoover also authorized a large increase in federal spending. Before that. So why was it mischievous? Because now people would know that that bank was in trouble or that bank was in trouble, and they would run on that bank. So the very act of trying to save actually destabilized trust. It was like marking certain banks which would be recipients of support as unworthy of trust. So in fact, it achieved the exact opposite of what it would have achieved had this been done without marking certain institutions and banks as untrustworthy. Because it's all, as I keep repeating myself, a matter of trust and breaches of trust. So in fact, once you publish all those institutions that approach financial help, you're actually marking them as institutions that are untrustworthy and therefore bring about their ruin, because there is no separate tangible institution and trust in that institution. But the trust in an institution constitutes that institution. The trust is removed, there is no institution. It breaks. There's nothing else. It's just that. It's just embodied trust. Okay, additional problems. Hoover also authorized a large increase in federal spending on work relief projects. But the federal budget at 4% of GNP was too small to make a noticeable dent in the growing social distress. Everything was falling apart. Inevitably, declining revenue forced the budget into deficit for fiscal 1931. The deficit was too small to exert an expansionary effect on the economy, but it did enable Roosevelt to attack Hoover during the election campaign of 1932 for failing to appreciate the necessity of economy in government. So it's really... you needed a great deficit here. This was the time for a deficit. Come on, spend, put money in the market, print money like crazy and let the people live. Spread the trust, spread the bounty of trust. No, we have to be fiscally responsible. You can't have too great a deficit. They didn't know yet. They didn't know the importance of a deficit, the importance of the balance between a deficit and a booming economy, all those fine details that governments to this very day are still struggling with. And especially they didn't understand this issue of embodied trust that underlies all economic activities. So, in fact, the government was now under attack to save, not to bring about a deficit. Ironically, the budget deficit of 1931 was the most expansionary of the entire decade, though no one at that time saw this was a benefit. Nobody knew that that's what they had to do. So in fact, they did the opposite. Unfortunately, Wright, Crafts, and Fearon, Hoover soon re-embraced deflationary policies. In 1932, he became so concerned about the domestic and foreign disapproval of the federal budget deficit, which he believed would have led to speculative attacks on the dollar, that spending was reduced. And the Revenue Act introduced a raft of substantial tax increases. So when people are starving, when jobs are contracting, when the industry is in tatters, production is in tatters, people have no trust in the system, now they impose taxes. On what? What are you going to tax? You're going to break it even worse. In spite of his efforts, the budget remained in red. And not surprisingly, unemployment remained stubbornly high, of course, because what did you do to put the trust back? It is a misfortune that Hoover's understanding of contemporary economics led him to an unshakable belief in the gold standard. We're back to that. He shared with many contemporary economists the view that fiscal and monetary policies must be directed to support gold rather to directly promote domestic economic expansion or bank stability. So again, we are back with the golden calf. This is your God. This is thy God, your God, O Israel, as it were. This is the God that we worship. The gold standard, this chimera of a tangible material substance that incorporates, as it were, the trust in the value of money. But of course, this is a chimera, because what actually gold does when it is the standard is allow people to make commerce with each other, to trade with each other, to use money for their interaction and their cooperation in building a civilization. But it is not gold that does it. It's the belief in the gold. But when that is shattered because gold can no longer provide sufficient currency, when you need to print money in order to promote domestic economic expansion and bank stability, both depending on liquidity, on printing much money so that everyone who needs it can have the money to buy stuff, to build stuff, to found industries, to finance whatever the economy is doing, and all those great inventions, all the wonderful things that come about when there is plentiful currency. As we read in the previous talk from Benjamin Franklin, all this does not depend on gold. It's just trust. So this insistence on this belief in the saving grace of gold, as if gold is the thing that would help succor the system if we could just go back to it. This harking back onto the golden age of gold, in fact, undermined the entire system. And instead of allowing the government to see where it was and actually support trust by giving trust, trusting the banks, trusting the people by putting a lot of liquidity into the market, into the system, and thereby allowing people to start living their lives, to start actually continuing to advance civilization. Because as we discussed before, this clinging to the materiality of one commodity, in fact, undermines the very expansion of human endeavor, which hinges on sheer trust. It's only when you release it, when you release this tendency for real money, for realistic, as it were real, but it's not real. It's this clinging to the real, and the gold was the real, as it were, standard. This clinging to the real undermines the quiet, idealistic, and unreal true action of the market. Because what is the value of innovation? What is the value of someone dreaming up some new fangled something, let's say inventing the telephone? No, that was before, so it was already in the market. But something new that came afterwards, so many inventions that came after this period. So an invention comes into the market. Where will it get the support it needs to expand into civilization? It needs the trust. But when everyone is sitting on their gold and withdrawing from the market, there is no money for inventiveness, for production to create new worlds. Because this is what civilization actually brings about. It brings new worlds into being. And these new worlds are not in the CPI. Because the consumer price index can only look back on what was. It can never see what will be. And what will be is only supported on the great tide of trust in money, which is disembodied by nature. And today, of course, we are getting nearer and nearer to this true disembodiment, where most of our money are just numbers on a screen. Not even there, it's just virtual, it's electrons on our screens. And even today, this is there's still this stepping stone that hasn't been transgressed yet, where people are dreaming up all kinds of obstacles like cryptocurrencies. We will hold on to the cryptocurrency because everything is so unreal. And there are so many people putting out bad economic advice that sounds so good, so solid and Protestant, talking about tangibles and providing like subversive ideas about the economy, because they distrust this expansionism, this total liquidity that saved the market in 2008, and want to go back to the tangibles, not realizing that there are no tangibles. The tangibles are also illusory. It's just the tangibles are now holding us back from fully embracing an economy of trust and perhaps finding ways to shore up that trust by facing the fact that this is what actually holds the economy. And that when people lose faith in banks or in money, they lose faith in the system. And thereby, they actually lose faith in faith, lose trust in trust. And the system thereby contracts and collapses. So, in fact, this attempt to support gold rather than to support the market led directly to terrible consequences. And ultimately, we will see a shift in government ideas that now focused on other types of tangibles. And this is the period that gave rise ultimately to communism, to Nazism. Well, actually, communism came before, but it was, let's say in the West, a lot of socialism occurred as, or grew as part of the idea that we can save the market by redistributing wealth, as if wealth were a tangible artifact. And this is the fallacy of Marx, This is the fallacy of communism and the fallacy of most governments when they start thinking about money, assigning to it tangibility. And we will see how this created further decline. Okay, so see you in the next discussion.